Hey guys, V. Rigoni, Max, high performance real estate entrepreneur. So today, what are we talking about? Well, we're going to be talking about a podcast that I watched recently. It had to do with multifamily and how this guy was like struggling and nasty. So let's get at it. But first, if you like the content, subscribe to the channel, hit the like button, all that kind of stuff. Leave a comment, ask a question. And again, positive, negative comments, all good to me. So I'm watching this one podcast. I'm not going to name the podcast because, I just don't know that that's appropriate. But there was a fella on this podcast that was a large multifamily operator who became fairly large in the last several years of the bull market in real estate, which pretty much ended somewhere around 2022. I think he was saying like February or March, or there was a point where he named the exact month. It doesn't really matter. But they had been buying really heavily into that point. And I'm talking heavy. It was like, I think the guy said they were like around 3,000 doors. And as you know, in the multifamily space, we call an apartment, an individual unit, a door, right? So if you got a 34 unit apartment building, you got 34 doors. So this guy's got like close to, he said to 2,500 or 3,000 doors. Dang, we're talking big money. But they were very aggressive in buying these units in the last phase of the last bull market, right? And so, I'm assuming most of what they had bought was prior to COVID, and that kind of thing. And then they bought a lot that came right after COVID. So, maybe I'm actually kind of wrong. Maybe it was mostly during that, from that COVID to 2022. That was that year and a half. But they just blew up in the number of doors. They were looking at the fact that, this was before before everything that's really gone on financially up to this point. So anyhow, what's their struggle? What's the struggle they're having? Well, number one, they were they were saying that they had a lot of properties in the workforce housing, which is, gets a little bit more kicked around during bad economic times because the people don't have, their jobs are less sophisticated, blah, blah, blah. They don't have the personal economy of someone making more money. They live more week to week. That's one aspect. But the big deal is what I've been talking about. These are one of these groups that are going to be hurting based upon the things I've been talking about. They put a lot of debt. They put a lot of debt on their properties at the top of the market, and they used adjustable rate mortgages on a number of their big projects. And they're now, this guy was, one thing I can say about this fella, he was extraordinarily humble. He was extraordinarily honest, very transparent, beyond that what you would ever think of a lot of people. And so he was talking about the position they're in right now with a lot of their real estate is that the interest rates have gone up. The properties values have gone down on these multifamilies. They're heavy into Arizona and some of these other southwestern states. And that is really hurting them because what's happening is they had adjustable rate mortgages and also they had hard money loans because for a long period of time between 2015 to 2020, you could buy a property with a hard money loan. That's where you just go to private investors. You pay a high interest rate, but there's no penalty necessarily to get out. And then you're going to only hold that for like a year and a half to get the property. So you could go in and, and increase the value of the property by remodeling the units. And at the same time, after you remodel the units, then you're able to raise the rents, bring in new tenants. It takes about a year and a half to 2 years to do that. And they were doing this, and then they can turn around and they could either borrow more money off the property or they could flip it. And then they'd pay back the hard money. They'd have a much better loan, blah, 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 blah. The other way they were doing it is, again, they couldn't, when they would go to do the underwriting on some of these properties at the time, they were paying so much for the property that a 4% fixed rate mortgage, which was probably historically low, I've heard of 3, but mostly between 3-4%, they were getting historically low fixed rate mortgages, but they would do the underwriting. In other words, they would try to figure out what the cash flow was on the property. What is the economics of the individual property? And they weren't able to make the deal work based upon what the seller wanted. And the sellers were not negotiable. So they paid up for the property, and they would then go out and they'd put an adjustable rate mortgage on the property that could adjust even on a yearly basis. And so what has happened to interest rates over the last several years, last 2 years, 2.5 years? They went through the roof. So now that 2.5% or 2% interest rate is now at 5, 6, 7, 8, 9%. So they've got these buildings that have been remodeled that have great tenants in them, paying top rent in some of their buildings. They got other buildings where they're struggling to keep tenants. Either case, what's happening is that they got the cash money coming in, but the cash flow is now turned negative. And so then they also have to refinance these notes. Why? Because they know that it's not sustainable. So they're going back to either if it's with a mortgage company, Fannie Mae, Freddie Mac mortgage kind of company, they're going back to them and trying to get them to renegotiate their loan to a better rate. But the banks don't really have that much of an incentive to do that. So he's in a situation where he said, yeah, by the end of this month, we're hoping to be able to, we're going to be hoping to be able to restructure the loans. Whoa. When did we hear about that last? Remember we heard about that back in 08, 09 on the residential side when people were buying the Ninja loans, remember, adjustable rate mortgages, low rates. And then what happened? They went up. And so these guys are now in the same place that the homeowner of 08, 09 was, and they're in this position now. The only difference is they're not just losing their money. They've got investors. They did these deals with real estate syndications where they brought in other people's money. So they're literally sitting there with properties where, let's say they sat there and they've got this debt, and now the debt is eating them alive. And now the value of the property at the same time is going down in value. Real estate, multifamily real estate sales have been down. They were down 75%, 78% 2 years ago or a year ago. This year, same thing. They're not getting any relief. And so the valuations of their properties are going down. At the same time, the cost of owning the property has gone up because of why? Well, because of the fact that you sat there and you look at it and your interest rate went up on your mortgage. What else went up? Taxes have gone way up. And then we just were talking about in another video how insurance on inflationary side has gone way up. So you got taxes up, you got insurance up, you got people that are struggling with inflation on a personal level that may not be paying their rent, like they were. At the same time, property values are dropping. And so they're like in a vice. And what he's saying is, well, we've contacted, he's talking about all the positive things they were doing, that they had reached out to all their limited partners, all their investors. They keep them informed of what's going on. They let them know that they might need to bring in some additional money. Whoa. Now the host really didn't question him too much about that statement, but that didn't pass me by. You see, when you're a limited partner inside of a real estate investment and the property value drops and they've got to redo the mortgage, they're trying to restructure the mortgage with a property that's not worth as much as it was when they bought it 2 years ago, 3 years ago, 4 years ago. What does that mean? That means you got to bring in more down payment. You got to bring in more money. Well, it isn't really down payment because you already bought it. You got to bring in more equity. Where are you going to get that equity? Well, you got to go back to the original investors, and you got to say to them, hey, we need to do a call on money. Now, he's not saying that they're doing it right at this moment, but he mentioned that that's one of the things. Because if a property has lost value and you got to refinance it, you've got to bring in more equity. So there's like this perfect storm starting to take place with a certain number of multifamily investments where the people, were buying the deals that they should not have been buying, that went against all what their nature told them they shouldn't do. And that was go get an adjustable rate mortgage when interest rates were at an all-time low. Because if you get an adjustable rate mortgage then you can't make the deal work on a fixed rate mortgage when that's at all-time lows, and you got to go lower than that because it's an adjustable to make the numbers work, you think you might be screwing up. Like I've said, sometimes the best deal is the one you didn't make. But again, people do things, and I'm not saying they're doing it out of malice, but they make bad decisions. So this guy's got a portfolio of almost 3,000 doors. A bunch of them are in trouble. They're trying to renegotiate the debt with the lender, and they're saying they got a good relationship. Yeah, we can have a good relationship all day long, but why does the lender want to necessarily get a lower interest rate when he can get the rate he's getting? So they're basically begging at the door of the lender to please save them. Well, some lenders are going to work with the people and some are not. And for this guy's sake, I hope that, here at the end of this month it was supposed to be, I hope that it works out for him and the whole 9 yards. But I can tell you, folks, lenders, they get really, really nasty when your numbers no longer work. And so there's going to be, as I was saying, going forward, there's going to be a great opportunity. That opportunity is coming. And what's going to be really interesting is the number of people that are going to be investors that are going to be involved in looking at those opportunities is going to be significantly less than the number of people looking to buy deals 3 years ago. Why? Because a chunk of those people are in trouble. They're the ones that are trying to get out or trying to, because what happens is that when the lender no longer can work with you, or what the lender wants to do for you doesn't work for you or your investors, and even raising more money doesn't solve your problem because it's an interest rate problem, a cash flow problem, then you got to sell. And then you start selling at below what you paid for it, or at a huge discount as to what it got to. Because I'm listening to a podcast where in Arizona, they're saying outside Phoenix, around Phoenix, and I haven't actually gone out and double checked these numbers, but I have no reason to believe that what I was listening to was false. That on a B type asset, not A but a B plus, B range, the doors had gotten to be up to $300,000 a door prior to at the top of the market. They're down to $200,000 a door, is what the guy's saying. Now he's saying I really don't have a whole lot of comps to back that up, except when we're doing our underwriting, we're seeing that the sellers are willing to drop. And we believe that at this point in time, they've fallen back down to about 200. That's a third. That's what's happening right now. A third of the value has gone out the window because of the bad loans, because of what's going on, because of the pressure on these kinds of deals. So a third's going out the window. We think it drops by at least another $50,000 by the time we're willing to step in. So we're getting to that point where the opportunities are going to start to come. First, there's only going to be a few, but then there'll be a floodgate of opportunities. Now, I recently did a video that had to do with inflation and looking at real estate. And real estate is a hedge against inflation. This has nothing to do with the inflation in real estate. This has to do with the wrong kind of financing has taken a segment of this market and beaten the crap out of it, and thus it's caused some of the other properties to come down in value too. But they'll run right back up again as soon as this part of the business is over, as soon as this nastiness is complete. But the part of the segment that I was talking about mostly in the previous video had to do with single-family homes, which there's not enough of them available, and the prices are stronger than ever, and it's a whole different marketplace. You see, in the last crash, apartment buildings did really well, and single-family homes did horribly because of the kinds of financing. Well, now they flipped the financing situation, and so now single-family is maintaining itself, continuing to go up in value, but apartments are getting crushed, and they're going to get more crushed as time goes on. And that's what we're waiting for. You see, this was one of the very first interviews where we saw a larger portfolio, a guy who was running a large portfolio, what we used to call in the old days screaming uncle, hoping that the banks will work with him. Otherwise, he doesn't know what he's going to do. He's going to have to go back and raise all kinds of new money, or he's going to have to sell those properties that he bought at huge discounts and lose people money. That's the last thing he wants to do. But sometimes you got to get out. Well, there's going to be a lot of people heading for the exit door all at the same time. But remember what I've always said about real estate. It's very slow to go up. It's very slow to roll over. And it's very slow to bottom out. Because you're dealing with loans and mortgages and banks, foreclosure processes. They all take a lot of time. It's not like buying a stock that could be up or down 30 or 40% in one day. People vote with their buy order, their sell order. Here, you may want to get out, but there's all kinds of procedures you have to follow because of the bank rules, because of the government rules, everything, because of the rules regarding syndication. And you got to follow those rules. But they will lead to tremendous opportunities. And there are people waiting. Now, you might say, oh, that sounds really ghoulish. No. Did I tell any of those people that they should go get an adjustable rate mortgages in order to make a deal that they shouldn't have bought work? Because the deal was overpriced. They should have walked away from the deal. Did I tell them to go out and borrow hard money at 12 and 13% and then borrow more money to fix up the building and then get the building fixed up? But now the bank won't lend you what you need in order to get out of the deal? No, that's their choice. We're not talking about a little old lady that bought a summer cottage and you're trying to take it away from her at half the price. These are sophisticated people rolling the dice. And sometimes when you roll the dice, they roll against you. So we're going to be talking more about this because this is where the opportunity lies. Yes, you can buy a single family home, but you're going to pay up for it right now. You're going to get the appreciation as the time goes on. But do I want to buy where the prices are high, or I want to buy the part of the market that's being discounted? Give me the discount every day. That's called buying it right. Now, even on residential, you can buy some properties right. People want to sell, blah, blah, blah. But when there's great opportunities, you go where the great opportunities are, where the easier opportunities are. But you got to learn first. And that's what this channel is about. It's about learning some new things. It's about getting out there. And what do I always say? Think big, baby. Start now and grow fast.